everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, still from the open road. I'm joining you today from Connecticut, and this is where I'm going to be through Independence Day. Happy Independence Day, because I will not be joining you tomorrow. So I have a chart here, which I've previously showed, and this chart is from the San Francisco Fed back in late May, and it indicated that U.S. consumers had depleted the $2.1 trillion in excess savings that they had accumulated by August of 2021 during the pandemic. And for these purposes, excess savings are defined as the difference between actual savings and the pre-recession trend. Today's PMI data suggested that the pace of consumer deficit-funded discretionary spending is slowing, as we might have expected. On Monday, I suggested that sometimes the simplest hedging solution is the best approach, and I recommended the purchase of some 30 Delta August SPX or SPY puts. I wanted to follow up on this today because my rationale on Monday included the capture of the Democratic National Convention in the second half of August. However, the situation with Biden is fluid, and it doesn't look promising if you are a Biden supporter, because the reports that I saw today indicate that he is contemplating withdrawing his spot. And if he opens that door, it may be irreversible, as there are many forces prepared to essentially push him out the door should he open it. So I just wanted to talk a little bit, depending on the construction of one's portfolio, I was prompted to sort of get to the PMI thing first. And one of the bits of news that we saw today, in addition to the PMI data, which was negative, I think it's now the third sort of negative PMI print that we've had. So a PMI print below 50, by the way, and I believe we have the headline PMI number, which came in 48 and change. So any number below 50 is not a positive. The other thing that we got today in the news, which was unrelated to PMI, was that Marko Kolanovic, who was the global chief strategist at JP Morgan, will be leaving the firm. Marko is not a close friend of mine, but we are acquainted. I've met him several times. I met with him at JP Morgan with him and his team. I also have met him via CNBC on numerous occasions. Marko, and there's a reason why his departure, I think, is being pointed to as a potential indicator as far as the market is concerned. Marko's a very thoughtful, analytical, data-driven individual, PhD in physics and all of that. And he also had, amongst the major banks, the most bearish forecast for the S&P. I think his year-end target, and I probably should have written this down, was 4,100 or something like that for the end of the year. So significantly lower than we are right now. It's not surprising, given that we sit here essentially at all-time highs and having had that bearish posture for some time now, that pessimistic view would be quite painful for those following it. And I've seen some comments suggesting that his departure from the bank essentially marks the top. The idea being that when the last bear capitulates or is thrown out, in this case, the end is near. Actually, I don't know that he was thrown out. But it seems reasonable to assume that had his year-end target been 6,100 rather than 4,100, perhaps there would have been a different view for him here. So I have said on this live stream, in a number of articles, and in several private conversations over the course of the last several months, that this year, if I were to think about what it most reminds me of, it would be 1999. Now, when I first pointed that out, and I believe in an earlier live stream I may have shown this, part of my rationale for that was that the rally that we saw through March of this year was essentially unprecedented. There were a couple instances in the past where we've had such incredible appreciation as we did. And you know, I should probably, it's probably worth just showing how pronounced that rally was. So I'm just going to bring up the SPX index, and I was really taking a look at the performance of the SPX index between October of 2023 and the March period. And of course, we're higher now than we were then, but that was a really remarkable stretch. And I'm actually just going to bring this up here. By the way, some people had asked me, can you increase the size of your cursor? I may have overdone it. But if I point to things now, I'm pretty sure you'll be able to see it. So what we were dealing with here was a better than 27% increase in the S&P over the course of 106 sessions. That really was quite remarkable. And there was a period actually in 1999 that was similar. Now, there have been other big rallies in the market, but I discounted some of those. So what were examples of the ones that I did not include? I did not include the V bottom from the pandemic because that was coming out of a profound bear market. Same thing in 2009 through the end of that year. So if we go back to the end of World War II and we take a look at situations where you had the market rallying by better than 27% in the course of about, a third of, a little bit more than a third of a trading year. There were very few market situations that rhymed with that, but it did actually in, the last sort of, we'll call it the last 18 to 24 months of the tech bubble that basically ended in March of 2000. So let's just take a quick look at that. I think it's kind of interesting. Maybe I'll just go back to 1998 and we'll just go through the end of that period. So that should show up here. And this was basically the period that I was talking about. So it reminded me of basically this period that we had here also from October, as it happens, in 1999 through March, and then the market continued to rally through June. We did have this sell-off here. We might as well just take a look at the scale and scope of that sell-off. It was actually wasn't technically a market correction, about 13%, but the market didn't reach its zenith actually for that bull market, and that was all, of course, tech fueled until the third week of March of 2000. And it's this period right here that I felt was quite similar to the one that we're in. The most notable exception to this would be that 1999 was not an election year. I have spoken about and written about the fact, and many others have too, that election years, that their performance, people like to look at specific things in history and say, okay, maybe we can extract a little something from the data. I'm not necessarily sure that's true, though. And we don't really have that much election data going back because we only have elections every 4 years. But on Monday, when we were talking about Biden and the Democratic National Convention, it really didn't seem likely that he was going to step down. I have two things I would say about that. So first, obviously, I've already mentioned the fact that he may open the door to stepping down. If he does, I think then it's almost inevitable that he will withdraw from the race. But actually, there's another thing that I've sort of been thinking about, which is that, and there are different takes that people have had about this, but Kamala Harris is almost certainly the most likely replacement if he withdraws. It's just too messy otherwise. There's going to just be a maelstrom, I would imagine, if the party didn't try to select his vice president to replace him. So let's think about that for a second and what the implications are. And there are a couple. One that has a sort of a direct thing for us to think about with respect to what equities could potentially do. The first is this, and that is that if she replaces him, whether he steps down or not, and I think that's basically almost inevitable now. If you are voting the Democratic ticket, you are voting for Kamala Harris, even if he does not withdraw from the race. Because I think most observers would agree that the chances that he finishes out another 4 years is very low. That's very low. So she may be the top of the ticket as a candidate, or she, if he won, might just ultimately replace him. But I think that's kind of a foregone conclusion. All right, so if we take that as a given, and it's not 100%, I don't have 100% certainty on anything, but that seems like a reasonable assumption to make. Then the next question we ought to be asking ourselves is, okay, what are her chances versus Trump in the general election? The polls suggest that Trump would very likely win, possibly in a landslide, if he was facing off against Kamala Harris. Don't know. We've been surprised by some things. Certainly, I think many were surprised by Trump's election in 2016. I think many more were surprised that he lost in 2000. So I'm going to leave it to others to make a prediction about who the winner ultimately would be. But I do want us to think back to 2016 when Trump won and think about what happened to U.S. equities when he did. So the initial response in the futures market, largely because he was not expected to win, was that they sold off very briefly. And then they rebounded even more sharply. And we can take a quick peek at that, because what we're going to see here is that the market, and this is not a political commentary. I'm not advocating one person or another. I will leave that to everybody else. I know most of you are probably not listening to me for my point of view on that. There are plenty of people who are willing to offer it. If somebody asks, I guess I could answer it. But so this is what I would say, and that is that we can see after his election. So this is this period here, and I probably should make this a little bit shorter, because I think you can really see it much better. So here we are going into November 6th. So that's the 4th. This is the 7th. So these are weeklies, these are daily charts. So what we have here, though, and this isn't showing the futures market results. This is just S&P cash. So this is just going to be the calculation of the index during the regular session. What we can see is that the market just took off. And not only did it do that, but that strength continued for some time. And I bring this up because I don't think it would be realistic to assume, all else equal. So in the short term, of course, people are holding out hope for the Fed, but I think it's important to recognize that the market is probably going to view a Trump victory favorably. And why is that? I mean, there's a couple other things going on here. We just got a Supreme Court ruling. It was the deference ruling. This is important for business. What is the deference ruling about? That was based on a court case, I believe it dated back to 1984, involving Chevron. But the idea is that the interpretation of law, that there would be some deference to federal agencies that are supposed to oversee it. There is a logic to that, which is that Congress cannot contemplate every iteration, and it cannot evolve organically as the circumstances change and may warrant. That's a positive way to look at it. A negative way to look at it from a business point of view is that you end up with unelected bureaucrats making decisions about the interpretation of law in as much as it might affect business. Examples would be environmental policy, restricting business and things like that. So that Supreme Court ruling, in combination with the election of Trump, if that's what was to happen, would suggest less corporate regulation, less likely an increase in corporate income taxes, basically a more accommodating environment for business. And that's the reason I bring up 2016, because I think a lot of people had the view then, and still do, that Trump is a little unpredictable, and there were concerns. But the other side to that is that he was very business friendly, and he generally skews towards less regulation rather than more. And if you have more of a classical liberalism approach, that's positive for business. Okay, so maybe one of the things we can do here is we can actually just take a look at some of this PMI data, and then we can go and start taking some questions. So let's take a look. We had some slides, and maybe we can bring them up here. So this first slide, it was the slide I was just talking about. This was the slide that showed the decline in consumer savings. Important to note, this is, this isn't updated as regularly, but what I'm trying to point out here is that this did, in fact, essentially preempt the PMI data that we have now. So if we go to the next image, so this is just the PMI data that was released at a high level. Numbers below 50 are, contractionary, essentially. And what is interesting to me in all of this is that there's actually only one number that is above 50, and that's prices. So that doesn't necessarily tell me a positive story either. So if we go to the next one, what we're looking at is, this is just the overall headline PMI. Again, we can see now that we've had a number of periods below 50, including, I believe this is now 3 consecutive, or 3 this is, let's see, we've got, you can see the 50 line right here, but you can definitely see that since 2022, this has not necessarily been a positive. If we advance, and because I was chatting so long and making my idle comments about the election and Trump and all the rest of it, we can actually, let's skip ahead here and let's see here. So I wanted to go to, so we can see that, this is production, obviously, this is falling a bit. And one quick point I want to make also is that if you want to get more information from this is publicly available, ISM World, you can go there. This is the employment numbers, not as negative, but you can see that this actually has also ticked down. We can advance one more. I'm not sure which one was this. No, I had notes on that. So inventories, this would generally be thought of as being a positive. So there's 2 inventory numbers that you should be thinking about. And so a dropping inventory number, when you are thinking about businesses, is usually viewed to be a positive. So your instincts might tell you, oh, okay, so this is a lowering inventory number, that's a positive. But actually, it's the next inventory number that we probably want to take a look at. And we can see that one didn't drop as much. This is actually the customer inventories here. So if you can imagine, how much inventories do producers want to have on hand, a reflection of their sense of optimism for the economy versus what customers' inventories are, and whether those are dropping. We can advance one here as well. We can take a look. This is prices. So this is interesting too, and this is anecdotal, but I'm sure some of you have seen this as well. And that is that if any of you have bought a car within the last year, 18 months or so, you will absolutely have observed that incentives are back. We are seeing increasingly, 1.9, 2.9, 3.9% financing rates, discounts. If you go by the dealerships, you're going to see rising inventories. It's pretty clear that the auto market, at least, that's when we're thinking about consumer discretionary purchases, and we're thinking about big ticket durables, that's going to rank right up there. So when we see those kinds of things building, that's not necessarily positive. So why don't we go ahead and skip to the next one here. So this is an order backlog chart that we're looking at here. Again, order backlogs, indicative essentially. So we can imagine that the inventories are reflective. This is on the manufacturing side. We might think of that in some contexts as being indicative of producer confidence. Backlog of orders is indicative of the demand side. And Has it been lower over the course of the last 2 years? It has, but we're not trending in the right direction. The pace of declines is a little bit slower month over month, but it's not great. All right, so let's just step forward a little bit more here. And okay, so this one I tend not to focus as much on. This is the export orders. We also have an import orders chart, I believe. That was here. And yeah, so let me go back to sharing for a second, because one of the things I wanted to also show was the PMI data relative to, and I'm going to use XLY, the consumer discretionary, as a comparator here. So let's do this. So what I'm doing here is I'm just going to go back in time, and we can look at this for various periods. Now, if I look at it over a very long period of time, it becomes a little bit difficult to follow. And the reason for that is that because the PMI data is going to bounce around that kind of mean 50 number. So if you have a mean reverting process, so your chart goes above the mean, it goes below the mean, above the mean, below the mean, it becomes hard to compare something like that to the chart of an instrument whose price will generally rise over time, because eventually it's just going to look like a flat line. But what I wanted to show here was that there is a relationship between equity prices and PMI. And it's a relationship that often will show a lag. So for example, here in 2021, we can see that PMI data is starting to fall off a little bit. Equities had continued to rise, but then they end up falling sharply. We can actually go to earlier periods, and I'll try to do that. So if we're going to July of 2019, why don't we go back to 2014, and I'll go forward to 2019. And again, you're going to start seeing sort of similar patterns, which is that you're going to have rising PMI, rising equities. PMI starts to sort of flatline here, and then it rolls off. But there is a relationship. I guess my point is that, and we talk about these kinds of things pretty often, which is that the market is in the short term not going to be driven by fundamentals, but we can't ignore them, because sooner or later these things do come back to roost, so to speak. And I think that's going to happen. I think that's going to happen here too. Is Marco's departure from JP Morgan, when the last bear leaves, is that going to mark the top? No. But it is interesting that you get to a point where you essentially have only one single point of view. We're very much loaded on one side of the boat. Okay, so with that said, this is a holiday live stream, so I'm guessing that very few people will have tuned into this, but you'll have access to it because it's just going to be on the YouTube channel, and I don't think we need to dedicate too much time because tomorrow is actually going to be a trading holiday. But I did want to add those important points, which is that we've had one of the last bears capitulate. Biden is opening up the possibility that he will withdraw, and if he opens up that door, I think he's going through it. I think that will just create a flood. It's a little bit like opening up a door on a ship that's underwater. I mean, the pressure that's going to come in at that point is just going to wash him away. You won't be able to get it shut again. But I also think it doesn't really matter, because I think whether he withdraws or not, Kamala Harris is the candidate for the Democrats. Whether it's just understood that if that ticket wins, she will take over at some point, or whether it happens prior, I'm not sure that matters very much, because I have a feeling that having seen that debate and just knowing the conversation that's going on, that most people who are going to be pulling the lever in November will understand that. I've already seen, many of you have probably too, that there seems to be an effort afoot to promote her in some quarters and spin her more favorably. I think that we should expect to see more of it, but I'm not, again, sure that matters. I will say one other thing, though, and that is that my guess is that her polling numbers would improve over the course of time versus Trump if, for no other reason, that people who are inclined to vote for the Democrats anyway, confronted with that choice, tribalist politics being what it is, it's easy enough to say that they don't think of her as a very favorable candidate in a vacuum. But once they realize that that's the only choice they have, my guess is that they are going to promote that a little bit more. Wesley Yee has a question for us. So let's see. Hopefully I can. Some of you may have observed. I actually have the ability to show these, and I hope that's what I'm doing now. SPY is 12% over its 200-day moving average. Actually, oh, sorry, you meant SPY is over the 40-week moving average. Well, let's take a look, first of all. Let's take a look at the moving averages here. So you want 40-week. 40-week is the 200-day, so basically. So let me I'm just going to leave that up here, and we're going to take a look at that. We can confirm this. See where we are, give or take. And did I choose a percentage? 13%. Yep. You are correct, sir. It has been greater than 10% March 25th, July 24th of 23, leading 3-week declines. How and when might you play for a correction? Okay, so I'm going to just pull up OptionPlay again. So Wesley, I don't know if you happen to have tuned in for the live stream on Monday, but if you didn't, that's fine. I'm just going to rehash essentially or go over again what I was doing there. So quick point, when it comes to hedging or playing for some downside, what I was trying to do was just keep it really simple, come up with a simple example. At the time, I was looking at plays that would capture a downside move, but were on the long side of the Democratic National Convention. And that's because at the time, before I'd given it a little bit more thought and sort of recognized that I don't really see another avenue than Kamala. And I don't think that we should dismiss what the electorate's understanding of the situation is, whichever side of the aisle you happen to be on. Or if you happen to be a registered independent like me, that's a slightly different thing. But I think it's pretty clear. So what I had suggested was going to August month end and buying a 30 delta put. So the 30 delta put, as of today's close, costing less than 1% of the underlying, would be the August 30th month ending 543 puts. However, because I'm not sure that the Democratic National Convention is going to be such an important catalyst, I've sort of come around on my thinking about this over the course of the last 48 hours, and essentially I'm pretty much coalesced around the idea that Kamala is sort of the de facto candidate, if not the actual one. Democrats recognize this. I think everybody recognizes it. There will be some, I'm sure, who are probably trying to push for or advocate for others, Newsom, Whitmer, or whomever. But realistically, I just think that would create far too much strife. It would be very unusual, certainly for the administration, not to advocate for the vice president. That seems really strange. I'm not saying that I think she's the best candidate, but I think she is the most likely one as far as they're concerned. So going through the DNC would take you to these August 543 puts. However, what you were talking about were 3-week declines right after you got essentially too far, too fast. I think that's what you're saying. If you were looking for a 3-week decline, you don't need to go out as far as August. Now, what's interesting about that, let's just say you take a look at a 30-day option instead. And again, you're looking for maybe 30 delta. Well, that's actually going to take you up a couple bucks to a slightly higher strike. So you could contemplate, for example, something like the August 2nd weekly 545 puts. That's a 30 delta put. That certainly would be one way to play it. And let's just take a quick peek. Bear in mind, this score is a byproduct of one's target. So if you were anticipating a correction, let's say a correction would be a decline of 50, more than 50 points from here, but for whatever it's worth, why don't we just say 500? So we'll just take it down to that, for example. So we're thinking it's going to go down to that, and we think it's going to do that over the course of, let's say, by this time. Implied volatility, we're not going to make too many other assumptions about that. But, you're going to end up, with a trade that looks like this. You're going to be risking significantly less than, oops, why is that target price should be 500? There we go. So if it was going to have a decline like that, you can see that your risk would be 348 bucks. You're expecting to make, give or take, 9 times that amount in terms of profit. So a 10 bagger effectively on that trade, and this target price shouldn't say that either. That really should be the expiration. So this is certainly a way that you could play it. Corey Henderson says, looking at putting on a put debit spread for a hedge and protection, maybe before August through November in TQQQ, looking at December 20th, maybe the 8062. These got a lot cheaper over the last 2 days. Okay, well, let's take a look at that. If we can, yeah, there we go. Okay, so you were thinking about December 20th expiration. We'll bump ahead to that. Oops. And you were looking at the 8062. Okay. In the money puts, interesting. Okay. Not saying that's a bad thing necessarily. I'll admit that I don't usually do that. I'm more inclined to look for slightly out of the money options and then move into spreads if they're kind of working my way. So just an observation, which is fine. Okay, and this is backwards because actually you're doing it this way. OptionPlay definitely seems to like it in terms of the score. So I want to make a quick point about trading options on levered ETFs, ETPs, exchange traded products, exchange traded funds, and so on. And that is that you're going to observe that because they're levered and therefore are going to express or realize volatility consistent with the degree of leverage that they incorporate, the options premiums are going to account for that and be commensurately more expensive. So that doesn't necessarily mean don't do it, but what I'm saying is that there isn't necessarily edge in doing this trade on the triple levered triple Qs than there would be over a similar trade in the Qs that essentially is delevered. And actually, I'll illustrate that. So here we are. You're essentially taking an at-the-money put or slightly in the money put, and you're trading one that's $18 out of the money on an $80 instrument, round numbers, okay? And on this spread, which is $18 wide, you're going to spend about a third of the distance between the strikes. Okay, so if it was to decline by that amount, what would that translate to for a triple Q spread? Now, by the way, I will point out that levered ETFs, ETPs, kind of like what we were talking about on Monday, where you are dealing with ETFs that are dealing with roll costs, they tend to have an embedded cost related to their construction and to their portfolio management, and if they're buying options, to that optionality. It amounts to decay. And so what you will find is that if you are looking at something like a triple levered, triple Q ETF, it is not over the course of 10 years going to deliver 3 times the total return that the triple Qs unlevered would. And if they did, there would be an arbitrage because, of course, there is a cost to borrowing money. There's a cost to assuming leverage, and that cost is going to be embedded in the product. Doesn't make it an untradeable product or an unusable product, but it's just an observation. The further out in time you go, the more that plays into it. Of course, in this case, Corey is looking to make a bearish bet, and so those things actually do tend to weigh on the performance of these instruments over time. So if you're making a bearish bet, it would therefore seem that you're going to benefit from this. A quick point about that, and that is that market makers account for this to an extent in their forward pricing calculations. So again, there's not typically going to be an arbitrage. Okay, so now let's just take a look at triple Qs and say, all right, well, if I'm looking for something that's going to give me 20%, right? 20% downside, which is essentially what you're looking for on a triple levered instrument between now and December 20th expiration. So what would that translate to if I was looking just at the QQQs? So let's call it 6.5%, 7%, right? Let's use 7%, whatever. Again, it's kind of a round number. Or maybe we can round down, it doesn't really matter. But if you used 7% as your number on a 500, so down 34-ish bucks, 33, 34 bucks. So let's just take a look at that. We're going to go to December 20th expiration. We'll take the at-the-money puts. Those are going to be the 490s, thereabouts. Actually, yours were slightly in the money, right? So I'll just take the 492s, slightly in the money. We're then going to go out of the money by about 30 bucks and change. So that's going to take us down to the 460s, give or take. All right. And what do we get? So we have a $30 put spread, just a little bit more. What is the cost of that put spread? About 9.5 bucks, slightly less than the distance, slightly less than a third of the distance between the strikes. So it's going to be in line with that T triple Q put spread that we were just talking about. And bear in mind that that other one is going to be a little bit more expensive because of that forward issue that I was talking about. The forward price for triple Qs, as long as the dividends aren't too high, is going to be a higher number. And the forward price for the triple Qs, triple levered triple Qs, is going to have some of that embedded cost built into it. So the forward will be lower. So what you find is that essentially these are equivalent bets. They're not the same bet, but they're functionally very similar, which is that if I'm betting on a 20% decline in the triple levered triple Qs, then I'm over some period of time, then I'm looking for, round about just under 7% decline in the Qs, right? So 7 times that number. And what we get is that those spreads cost very similar numbers. Okay, so I hope that helps, by the way. So Mark Guthner, Hope you're well, sir. My friend, colleague, co-author, Professor Mark Guthner of Rutgers is on with us today. Tesla stock is on the run. One thesis is the performance of monitored full self-driving is telling people that full self-driving is just around the corner. Any thoughts, and would you trade it? So, a couple quick things about this. You know, monitored full self-driving. What's interesting is that, of course, a lot of people are using autopilot as if it is full self-driving. So, you know, we have, ostensibly it isn't available, and yet the services that the car offers at the moment are being used as such. This is, I mean, it's really a profound development, I have to say. And I haven't had a huge amount of experience with self-driving modes with other manufacturers. So I have used, we have a Tesla. I'm sure many of you who are viewing this know that. It's really quite remarkable. I also have a friend who works for Cruise. That's the self-driving company funded by General Motors. And so in the Bay Area, in the evenings, you actually can ride around in cars that are full self-driving. So that means nobody behind the wheel at all. But I'm trying to remember, I think it's between the hours of 10 and 7 in the morning, or 10 and 6, something like that. But you'll see Chevy EV Bolts running around in San Francisco, and there's nobody behind the wheel. And this is really a huge development. And I think, you know, my thinking about Tesla is that they just are ahead of the curve relative to other manufacturers on some of the things that really matter. Full self-driving is one, and charging, I have to tell you, is the other. I've spoken about this on the channel. You know, I had a plug-in hybrid vehicle myself. My wife has had a couple Teslas. I operated my car almost exclusively on electricity when it was local. And even over the entirety of my ownership of that car, which I got rid of not that long ago, more than 60% of all miles driven were on full electric. The fact of the matter is, if you have dealt with Chevy EVs like Bolt or Fords like the F-150 Lightning, we have rented these cars. We had an F-150 Lightning actually on Cape Cod recently. It is not convenient. And Ford, for what it's worth, has entered into an agreement with Tesla. You should not think about Tesla as just a car company. It's a whole lot more than that. And on the software side, so the technology such as full self-driving, I have every bit of confidence that they are, at least based on my experience, well ahead of the curve. Their consumers trust their product enough to use it even when they're told not to do so. And their charging network. It's simpler, it works better, it's where you need it. They're just ahead of the game. And everybody else has got a long, long way to go. And you know, it's also interesting because this whole thing has not been approached the right way, I think, by the original, you know, the legacy automakers. Tesla and Elon really thought about the entirety of it. From the moment that they decided that they were going to try to make a successful electric vehicle and start at the top of the market and work their way down, to understanding that charging was the biggest sticking point. And whether every idea they had worked out or not. So, you know, the solar panels, that seems to be essentially getting pushed to the side. I have a friend who has nothing but Teslas now. He's got 4 power walls in his house. He sells power to the grid. If you've had experience with those vehicles, with their approach, with their charging network, with their self-driving technology, with their minimalist thinking about what the experience should be, and compared it to everybody else, you just realize they're on a different planet. And that's not to say that every aspect of their cars is remarkable and exceeds every other aspect, because it does not. That's not the case. Model Y is the best-selling car. I think it's the best value car. We have one. We're on our second. But it is not the most impressive car on the interior. Some parts of it feel somewhat cheap. Doesn't mean that I wouldn't buy other cars for other uses. I have a 24 Land Rover also. But it is a tough row to hoe for somebody else to compete with these guys. We are going to increasingly go electric. I know people are right now saying, oh, Toyota was right. It's going to be all hybrids, this and that. It is a stepping stone. It is not fully fleshed out for the whole country to be in EVs. But the approach that Tesla has taken has thus far proven to be the right course and the most successful one. And they're the only ones that are selling these things profitably, right? So at the end of the day, if you're looking at a company that is going to be selling these products, you want to buy one that is making profits. Elizabeth B. Okay, you followed up. And Greg Forrest, I see you, so I'm going to get to you in a second, but this is sort of consistent with this thought. Thoughts on Rivian. So this is really quite interesting because I actually think their products are pretty well thought out as well. Have some good friends who own a Rivian. They seem to love the thing. My wife's boss just bought one. Apparently he's a big fan of it. But I will tell you, and I hope I'm not, sharing something that I shouldn't. I don't think I am. But Brian Sullivan, who's on CNBC, he's the anchor of the 8 o'clock show, 7 or 8 o'clock. Forgive me, I'm trying to remember what time his show comes on. He's a real car enthusiast. He's also an experienced race car driver, which is probably not advertised all that much. He purchased a Rivian and only had it for a short while. I guess he didn't find the suspension to be that great on him. It's interesting. Some of these cars, they need to have, really heavy cars have to have, thank you, Corey, 7 p.m. And the thing is, I watch it, I think it's great. So Max Myers is the producer of that show, Last Call. I think Brian's doing a great job with it, and I think Max is doing a great job with it. But just had a little bit of a Biden moment there as I was trying to make my adjustments between California time and your time. Shouldn't be that difficult for somebody who has traded options for a living to subtract 3, but there we go. In any case, here's the, this is interesting. So they got a $5 billion investment. They build a quality product. And I think actually it's well regarded comparatively. Those are the positives. But my question, I guess, is where do we think these companies are going to make their money? Where do companies in general make the most money? What businesses are businesses that are great to be in? Services businesses? Why do people get excited about Apple now? Are they excited about Apple because of the margin that they make on iPhones? Or are they excited about Apple because once you're in their ecosystem, you're essentially tied to all of their services? And that those services are essentially attached to everything. That they charge a big chunk on the App Store. The difference is that I think Tesla has technology that they're going to be selling to other companies, and they have infrastructure. They have the supercharging network. Is it possible that others could build it? It's possible. Is it likely? Does it make sense for them to do that? Or does it make more sense for other companies to do what Ford has done and can't beat them, join them kind of a thing? I will say this, that the $5 billion that Rivian received, I think, was an enormous vote of confidence. And they make a good product. It has some novel ideas. As a car company, I think it, well, let's take a look at it also while we're at it. Let's take a look at what the multiple is on this thing. Because I think the move that it made net of that investment which was substantial. I think it was what, up 15, 16% on that day. This move, let's check. I remember I was actually on the Cape when they announced this, and a lot of people were saying, "Oh, look how sharp that move is." Look at that, 30%. So it was actually much more than I even remembered. But the question is, was that too much or too little? My thinking on this is that this is a business that is competing with other automakers, and Tesla is really in another area. So, I have to say, they're the biggest, they're the best, they have the infrastructure story. They've got data too, by the way. When it comes to all of this stuff, data matters a lot. And I don't know that anybody has more data than Tesla has. Doesn't mean these other companies can't compete. I think Rivian's a better investment now, even at its higher price, net of the investment that they received beforehand, because it's an enormous vote of confidence. I think there potentially could be more capital behind it. As you can see, if you're looking at this Bloomberg screen right now, they do appear to have ample cash on hand, which I think is a real positive. So, yeah, I think it's okay. I think it's better now that they've got the $5 billion. I'd rather pay up 30% for it now, net of the $5 billion, than I would before, because they have a lot of room. So Tucker D. Dog says, according to Car and Driver, Ford lost $130,000 on every EV they sold in the first quarter of this year. And Tucker follows up by saying that Rivian lost $32,500 per vehicle. I will make one quick point about these losses, and that is that, and this is not meant to be a knock on Tesla necessarily, but it is something I will just mention in support of Rivian as a customer service business. And that is that the people that I know that bought Rivians, in many cases, had ordered them well in advance. They were told there were going to be certain prices, and prices had increased since. However, Rivian stuck to the prices that they had originally guaranteed them. So if their new pricing is indicative of what they need to sell their cars for, bear in mind that the trailing losses that they've seen on vehicles sold incorporates the fact that they were selling cars at a known loss because they had previously committed to sell them at that price, even though the costs went up incrementally in the meantime. From a shareholder's point of view, you can say, well, why am I going to be supportive of management selling a product at a loss? I would offer you this counterpoint, which is that the experiences that some people have had with EVs haven't been that positive. Rivian is trying to make sure that people have a very positive view of them as a business, and that goes a long way. So I was not a beneficiary of this at all, but I was impressed that they elected to do that. They're in a fine cash position. It's an investment in the future. I think it's fine. But I still think that the charging thing is something that everyone may end up, converging to a common, basically platform and technology and charging methodology. By the way, some of these EV fast chargers, 100 kilowatts, 50 kilowatt hour, 50 kilowatts, 100 kilowatts, often promised at the EV Goes, Electrify Americas, all of these places. You're not getting what's on the tin. And that is not the experience you get at a supercharger. It just isn't. You go, you plug in, and it's done. With relative speed. The car knows when you're going to need a charge. It directs you to one. It starts preconditioning the battery. It's just a different process. Others will come around to it, but I'm guessing that they do it on Tesla's technology. Just a guess. Okay, so Greg, you had asked question, thoughts on energy plays, currently short puts on some, any other strategy. So this is interesting, yeah. And I hope I'm sharing this. these things have had a heck of a run. Deservedly, right? I actually had advocated a long view on some energy plays outside of the most obvious ones. So, and on that, I think, yeah. So, Constellation. I think I think it's okay. My problem here is that after you've had such a pronounced run, is short puts the way we want to play it. Now, here's an interesting. Okay, so I'm going to make a point here that I think is kind of important, which is that when people start constructing strategies, like a call spread risk reversal, for example, where you buy an upside call spread and you sell a downside put, to some it might seem convoluted or complicated because it involves the execution of 3 different options legs. The fact is that, we're really just sort of slightly manipulating a general concept, which is short optionality with a bullish bias. So a call spread risk reversal is, believe it or not entirely dissimilar from being short puts, because I'm net short options, I have limited my upside, and I have downside risk to 0. The difference between them, though, is that rather than just trying to collect premium at maybe a slow and steady pace, I'm playing for some capital appreciation while giving myself a buffer if continued appreciation isn't going to take place, which brings up this constellation chart that I have right here. And I know some of you can prefer candles. And I show this because we can see that, we've had a tremendous run, right? This thing's up 80% or so, this year. And so selling downside puts, while consistent with our fundamental view, may not really give you the kind of, is the juice worth the squeeze kind of thing. So I will tell you that I'd probably favor things like call spread risk reversals. So rather than trying to just collect decay, it's okay, right? If you're in this to collect premium, and some people rely on the income, that's fine. But I will say, I think I'd rather play for the capital appreciation side, since I'm taking equity-like risk in something that really chops around quite a bit. I think my preference would be to sort of play for continued upside with a buffer rather than just try to collect a modest amount of decay. So what would that look like? Let's compare them. So we're just going to put Constellation in here. And Greg, if you don't, did you put down? You didn't. Could I just follow up? I don't know if you're still watching, but if you are, just let me know what expiration we're looking at. We can actually put those very specific ones in. Okay. So, and also technically, one could argue that these things they have kind of rolled over a little bit. So the market's at all-time highs, and these are not. A little bit of a divergence thing going on there. So another thing just to be cognizant of if you're selling downside puts. August 16th, perfect. Okay, thank you. So let's just take a look at that. So we're going to go out to August. I will choose for, let's just pick this one. We'll pick the August 190 puts. You collect $5. We'll call that a little over 2.5% of the current stock price. This should be a sale. Okay. So not terrible, right? Decent probability of profit, ignoring the technical aspects for the moment, because it is showing a little bit of relative weakness lately. So that's not a positive from a technical point of view. But you're collecting 2.5% over 44 days. This adheres to many of the rules that I talk about. 70% probability of profit on a short option. That's good. Less than 45 days. That's good. Better than 1% yield per month. That's good. So far, so good. But let's just take a look at where this thing, has been. And actually, from this perspective, you could argue that there is some measure of support down around this level. So 195. You can see actually that it's held well above that since early May. Yeah, so it's not a bad trade. Not a bad trade. But let's compare it quickly to what the risk-reward relationship would look like if we maintained that same expiration, but changed it up just a little bit. So we can, we're just going to switch that to a call. We can sell a downside put. We're going to sell an upside call now. Tried it. And let's see, where were we? Around 175, way back there. So I don't even know that you need to go to the 175s. We could probably just pick this to the 180s, something like this. And we can bump this upside call. Okay. Doesn't even need to be that far out of the money. Okay, so now we end up with a strategy that looks a little bit like this. Now the objective here would be to try to get this close to zero, maybe a mild credit. This probability of profit number, be better if it was a pointer, 33.27. So if I make this, if I just adjust this strategy to the point that I'm actually going to be collecting a credit, and I might not be able to with this expiration. Can I find one where I can? There are. So just to make the point here, you can see that the probability of profit here is now 70%, but it's a nominal profit, right? Really what we're talking about is how much upside can I get, which is $20 worth in this example. Where do I actually get long? Down at the 185 level in this example. The truth is, actually, I'm kind of surprised by this. Maybe there's just not as much skew as I would have expected. So I may have to take back one of the things I just said, which is, the premium on these 190s isn't terrible. I don't know which strike you had chosen, but that's not a bad one. I mean, it's also not a bad one in terms of levels. But technically, it's a little ticklish. Let's see what some of the technical studies have to say on it, because it does feel like it's kind of rolled over a little. So of all of the better performing technical indicators, ignore buy and hold because that's not a technical indicator. It's just an investment strategy. It always just assumes you owned it and always will. So that's just for comparative purposes. So from a short-term trading perspective, these are the technical approaches over the course of the last year that have actually been profitable. And interestingly, only one of them would be long here. And let's take a look at one of these moving average indicators and see when and where it would have gotten out. And it's probably right there, see, triggered by going underneath the 50. So this is the weighted 50, went beneath, so that triggered a close of a long and go short. So that's, and you can sort of see this. We weren't looking at the lines, we hadn't drawn them. But that is certainly an issue. Okay. So the thought is strong uptrend with the recent pullback creates the opportunity for lower strikes to be viable. Okay. Okay. So that's interesting that you bring that up, right? Because if we go back to the OptionPlay chart, one of the things that we are seeing actually is that you are approaching some measure of support. The problem is you're approaching some measure of support. That is to say that in the short term, it does feel like that price is declining. But if you create some measure of backstop, number one, it is true, you're going to have the stock put to you at a discount. And actually, it's not an immaterial discount. Some of those 190s, the stock was over 230 recently, right? So you're going to be potentially buying the stock at nearly 20% discount to the all-time highs that the stock experienced right back here. So, we're looking at end of May. The other thing I want to point out too, and this is just, everybody's trading approach is going to be a little bit different, and I don't know how long every viewer is going to be different. Some of you buy stocks and probably hold them for forever. Others are going to be day traders. A lot of that is going to impact how these things work. I will say that if you believe that stocks are going to trade within certain ranges and you have a feeling or sense of what those ranges are, so if you are going to be bound by the fact that there is some support here at 195, even if the stock is trading lower, and even if those who are trading around a moving average would be short here because it crossed below it, that doesn't mean that you don't start selling puts when you believe that some form of a bullish reversal might take place, and that you don't then go ahead and sell upside when the opposite happens. We were just talking about the market generally, the fact that it is pretty extended above the 200-day right now, 13% above it. And on top of that, it tends to lag fundamental indicators, some of which we've received and aren't overwhelmingly positive. So I think that's fine. Although I will say, if you're going to sell upside, sell call credit spreads. I'm not really enthusiastic about selling naked upside in almost anything. Things just have a tendency to run farther, faster than we tend to think possible. It is a holiday. Tomorrow is Independence Day. And I have kept those of you who stuck around for all of this on only a half trading day for over an hour now. So I really appreciate your time and attention, and sort of my spontaneous remarks and thoughts that I've had as I sort of contemplated what's going on with Biden, what's going on with the market, what would happen if Trump is reelected based on what has happened before, what could happen with the market based on what has happened before, 1999 being the thing that this market has most reminded me of. And I hope you find some of this helpful, and that you can kind of incorporate it into your own process and find some utility. One other thing, so other than liking and subscribing before I sign off for today, and maybe ahead of the next live stream that we do, if you have a general set of questions and you want to, maybe what we'll try to do on Monday is just kick the live stream portion off first, which means that the chat will open up sooner. And you guys can just dump your questions in there, and we can maybe just frame the conversation a little bit more spontaneously around what it is that everybody's thinking about. So, we're kind of in a experimental mode here, and I'm just trying to figure out what works best for everybody. But that might be something we could do, is open up the chat a little bit sooner, put your questions in, whatever they are, and if we can find some themes in there, perhaps we can frame the conversation around that. So with that said, I want to thank all of you for watching once again. Happy Independence Day.